Imagine investing just $100 today, then doing absolutely nothing. No extra work. No second job. No winning the lottery. Yet years later, that money has multiplied on its own. This isn't magic. It's called compound interest, and Albert Einstein is often credited with calling it the eighth wonder of the world. Whether or not he actually said those exact words, one thing is certain: compound interest has helped millions of ordinary people build extraordinary wealth. So how does it work? Most people understand simple interest. If you invest money and earn interest, you receive a return based only on your original investment. Compound interest works differently. Instead of earning interest only on your original money, you also earn interest on the interest you've already earned. In other words, your money starts making money. And eventually, your money starts making even more money. Let's look at an example. Imagine you invest $1,000 with an annual return of 10%. After the first year, your investment grows to $1,100. In the second year, you don't earn interest on $1,000 anymore. You earn interest on $1,100. Now your investment becomes $1,210. The following year, you earn interest on $1,210. Notice what's happening. The growth gets bigger every year, even if you never invest another dollar. This is the power of compounding. Now imagine something even more powerful. Instead of investing once, you invest $500 every month. Month after month. Year after year. Over time, those regular contributions and compound growth can build hundreds of thousands of dollars. This is exactly why many Americans invest through retirement accounts like 401ks and Roth IRAs. They understand that time is often more valuable than trying to perfectly time the market. Here's something surprising. Two people invest exactly the same amount every month. The first person starts at age 25. The second starts at age 35. Both retire at 65. Even though the younger investor only started 10 years earlier, they could end up with hundreds of thousands of dollars more. Not because they invested more, but because they gave compound interest more time to work. This teaches us one of the biggest lessons in personal finance. Time beats timing. Many beginners delay investing because they think they need thousands of dollars to get started. That's simply not true. Many investment platforms allow people to begin with as little as $10 or $50. The amount matters, but consistency matters even more. Another mistake people make is withdrawing their investments too early. Every time you interrupt compound growth, you reduce its long-term potential. That's why successful investors stay patient. They continue investing during good markets, and during bad markets. Because they know that wealth is usually built over decades, not weeks. Compound interest doesn't create overnight millionaires. It creates disciplined investors. If you spend every dollar you earn, compound interest can't help you. But if you consistently save and invest, even small amounts, your future self could thank you. The earlier you start, the less money you may actually need to invest. That's the beauty of time. Money grows. Then it grows faster. Then it grows even faster. Not because you're working harder, but because your investments are working for you. Financial freedom isn't always about earning more. Sometimes, it's simply about giving your money enough time to grow. So here's a question. If you invested just $10 a day starting today, where could your money be 10, 20, or even 30 years from now? The answer might surprise you.